Hi, my name is Areen Wani, and today I will be pitching the company Equitable Holdings. Equitable is in the financial services sector, and my recommendation for this stock is a strong buy. I have the stock at over 70% upside over the next 24 to 36 months, and by the end of this pitch, you'll understand why. Now, Equitable Holdings is a diversified financial services company that operates through two main segments: Equitable Financial, which offers retirement solutions, annuities, and life insurance, and AllianceBernstein, a global asset manager in which Equitable holds a majority stake. Equitable is also the number one seller in U.S. variable annuities and hit $1 trillion in assets under management as of February 2025. Now, my investment thesis for Equitable begins with its growing demand. With 11,000 Americans turning 65 daily through 2027, demand for variable annuities is only set to grow. Equitable is also shifting towards high-growth fee-based earnings with a $2 billion reinsurance deal in Feb 2025, which I will get into more on the next slide. Recently, Equitable has also had incredibly strong financial performance, with 2024 non-GAAP EPS up 29%, all while going through a transitionary period. Equitable's competitive moat also gives them a clear edge over competitors, backed by a deep distribution network of over 4,400 in-house advisors, which competitors find hard to match. Now, Equitable is speeding up its shift towards high-growth fee-based earnings, and its recent reinsurance deal highlights this. By reinsuring 75% of their life insurance block to the Reinsurance Group of America, or RGA, Equitable unlocked over $2 billion in capital. Equitable is using this to launch a $1.8 billion tender offer to increase their AllianceBernstein stake from 62 to 78%. This move aligns with their approach to shift towards a more hybrid model that is higher growth and lower capital. Now, the remaining capital is accelerating its $500 million share buyback, reflecting management's confidence in the company's undervaluation. Now, in the top chart, you'll see Equitable's 12-month stock performance up nearly 36%, significantly outpacing competitors and the overall market. As shown in the bottom chart, since announcing the reinsurance deal, Equitable's stock price has risen 0.56%, outperforming the overall market, which declined by over 7% during the same period. Now, Equitable is well positioned in industries poised for significant growth. In the insurance and annuities industries, the retirement wave is driving record demand, and we already see this with U.S. annuity sales hitting record levels in 2023. The asset management industry shift from high-fee active funds to low-cost ETFs has led AB to increase its ETF offerings. However, with recent market instability, people are shifting back towards actively traded funds, which AB specializes in. Regulatory and economic pressures have also in ways benefited Equitable, as the Secure Act supports annuities and 401ks, boosting demand. So, currently Equitable has a widening moat due to increasing demand in variable annuities and recent initiatives leading to more diversified revenue streams. Their strengths nicely align with their widening moat. However, on the weaknesses side, their legacy liabilities, which are older life insurance policies, require significant capital reserves. However, the recent reinsurance deal with RGA offloaded many of these legacy liabilities. On the opportunity side, Equitable is tapping into high-growth areas like private credit and ETFs by increasing its ownership in AB, which has already entered these markets through its acquisition of Carval Investors. And lastly, despite strong market positioning, recent market volatility and regulatory risk remain a threat. Now, Equitable has 5 main revenue drivers, and the way I see it is they form a house. At the base of the house are annuities and AllianceBernstein, Equitable's largest and most reliable revenue drivers. In the middle sit life insurance and group retirement plans, acting as support beams as these revenue streams drive client retention. At the top is wealth management because it's a high margin and fast growing sector, elevating the house and Equitable, of course. But what about inside the house? Well, many were happy retired clients, of course, And in the center is a graphic showcasing Equitable's superior revenue growth over competitors, acting as a fireplace in a way because, well, who wouldn't get all warm on the inside looking at a graphic as beautiful as that? Now, without getting too deep into the numbers, Equitable's financials tell a clear story of resilience and growth. Revenue, EPS, and assets dipped during repositioning, but rebounded strongly in 2024. Free cash flow also surged in 2024, reflecting improved efficiency. And lastly, key metrics such as ROE, EPS growth quarter over quarter, and the current ratio highlight the company's rise in profitability and strong momentum moving forward. Now, my price target for Equitable is roughly $89 per share, over 70% upside from its current value. I used a DCF and relative valuation model at 12 and 10% growth rates, and averaged the four outcomes, bringing me to a price target of $111. I then took a 20% margin of safety to account for risks and unavoidable model inaccuracies, bringing me to the $89 price target. Now, the chart to the right compares Equitable to competitors. While it leads in all metrics shown, I want to highlight the PEG ratio of 0.78, the lowest among its peers, displaying the stock's undervaluation. Of course, every investment carries risk. For Equitable, key risks include the high volume of insider sell-in, interest rate and credit market shifts, and execution risks from the RGA reinsurance deal or AB tender offer. However, Equitable's brand symbol of Athena, the goddess of wisdom and war holding a shield, reflects Equitable's strengths and strategy to protect itself from these risks. Now, management and governance are often overlooked, but for Equitable, it's a clear strength, as the company landed at number 6 in Glassdoor's 2024 Best Led Companies, with CEO Mark Pearson holding an 87% approval rating. Pearson has been CEO of Equitable since its 2018 split with AXA and has propelled the company to nearly 300% stock growth over the last 5 years. Now, looking at ESG considerations, Equitable has cut emissions significantly as seen in the bottom right chart and aims for net zero by 2050. Socially, the Equitable Foundation donated over $8 million to nonprofits and provided over $1.3 million in scholarships in 2023. Governance at Equitable strongly focuses on ESG goals, with part of executive pay tied to upholding ESG commitments, which is supported by Equitable's strong diversity training. Lastly, Equitable's $1.6 billion impact investing program, shown in the bottom left graph, displays the company's commitment to sustainable investing. Finally, artificial intelligence. Equitable is already utilizing AI to streamline operations, cutting its quote processing time and errors by over 80%, assisting with life insurance underwriting, leading to faster approvals and lower costs, and optimizing hedging strategy in annuity risk management. While AI introduces risks such as fintech and insurtech startups utilizing AI to offer low-cost robo-advisors, faulty AI models, over-reliance risks, and ethical risks as well, Equitable's hybrid approach, blending both its human capital with AI, will effectively hedge against these unavoidable risks. So, at the start, I said you'd see why I have over 70% upside on Equitable over the next 24 to 36 months. And after covering its widening moat, diversified revenue streams, strategic reinsurance deal, and strong financial momentum, I hope you share my positive outlook on Equitable as well. Thank you so much.